All right. Good morning, everybody. Good morning and happy Friday, everybody. Today is July 17th, 2026. Our top story this morning, tech is selling off ahead of the open. We've got more volatility in Asia, more worries about the AI bubble bursting. This time, the particular flavor this morning is Moonshot. That's the name of the Chinese company that has just released yet another AI model. Oh, good, just what we all need, another large language model. Yep, Moonshot has released the Kimi K3 model. And okay, they've got their silly benchmarks, and they're all like, oh, it's as good as Claude Opus or Sonnet or Sol or Luna, whatever the heck they're calling the latest models. It doesn't matter. There's so many of these freaking things right now. They all do the same thing. They're talking about how this is another DeepSeek moment, or comparisons to DeepSeek, which was the last time the Chinese came out with an ultra cheap AI model, and everybody was like, well, maybe we should stop wasting hundreds of billions, dare I say trillions of dollars on data centers if the Chinese are just going to copy our IP and then spit out a duplicate of it for a tenth of the cost. We're like, now, you know what? Let's spend a few $100 billion more on CapEx and then wait another year until it happens again. And here we are today. Look, guys, as I said, the AI space is becoming commoditized. And when the AI space is commoditized, you've got no moat. It means there's nothing special about your product. It's the same as what the other guy sells. And that typically results in a price war where the price to produce that, where the price to purchase that commoditized service or product drops dangerously close to its cost of production because there's really no edge anybody has on it. And look, these companies all lose money already. They're already losing money. So if there's a price war starting and they already lose money, that means they're not going to get better. They're going to get worse. You guys following me? Some of you AI bros, I know. So guys, it's a little early in the morning. Some of you guys are a little slower on the uptake. In other words, it doesn't matter what the tech CEO told you at his TED Talk. They're losing money and they're going to lose more, which means this whole bubble is going to go kablooey. And look, if the revenue stops growing, that means the investor cash will stop flooding in. If the investor's cash stops flooding in, they can no longer pay for their compute usage, which means the CapEx will eventually dry up. And that first hyperscaler to announce that they're cutting their CapEx, you better believe this market is going to puke on that news. And we've got big tech earnings are coming up in the next few days here. So maybe that's this time around, or maybe rinse, repeat another 3 months. Now, as we mentioned, that volatility was led in Asia again. South Korea was closed for a holiday yesterday, so we don't have any update on the Kospi index. But Japan is saying, hold my sake, because the Nikkei 225 was down 4% yesterday. In particular, we've got this company, Kioxia, which is very briefly was Japan's most valuable company. They surpassed Toyota earlier this year. That is before they lost more than 50% of their value in less than a month. Kioxia is a memory chip maker. Again, this sell-off in memory stocks, it has been brutal. We've got SpaceX is now trading below their IPO price. So last I looked, they were at $125 per share for SpaceX. Look, there's a story about a launch was getting delayed. That's run-of-the-mill stuff with a space company. The big thing here with SpaceX, it is the AI trade that's dragging them down. And we've also got Nebius, the NeoCloud, or the margarine of CoreWeave, if you will, CoreWeave Lite, Diet CoreWeave maybe. Nebius was down 14% yesterday, a day after they unveiled their new asset-light model. And I love this. This is a sign, in my opinion, that the CapEx cuts are coming. As it's often said, it's better to have a friend with a boat than to own a boat yourself. And what Nebius is doing is Nebius is saying, we're going to let other people build the data centers, and then they can put them on our platform, and we'll negotiate the contracts and handle the networking and all that other stuff. In other words, Nebius doesn't want to endlessly pour money into data centers anymore. We'll let those crypto mining shitco's do that, and then they can sell through our platform. Now, Nebius they stand out from the other neoclouds and the other hyperscalers and AI bros because Nebius has been very slow and borderline responsible with their capital allocation. They haven't taken on huge amounts of debt or the big bond offerings, unlike the other companies, which is just more cash, more GPUs. Nebius has been more careful. So the fact that they're doing this asset light model now, It's very early in the stages of CapEx cuts. If anybody was going to slow first, it was going to be them. Well, now it is them. They have slowed first. When CoreWeave, when Microsoft, when Amazon slowing their CapEx? That is the big question. Now, we've got Netflix is getting clobbered this morning as well. Their earnings failed to impress. Their guidance came in a little light. We've got China's top 3 airlines are warning about heavy losses this year. Now, this is interesting for the oil trade. What's going on with these Chinese airlines? They can't raise their prices, but they have to raise their prices. You've got higher jet fuel is making the cost to operate these airlines significantly higher. So typically they would pass those costs on to consumers. But the wealth effect in China, the Chinese consumer is not doing well. His house is worth much less than he paid for it, and therefore he is tightening up his spending. So if the airline fares go up, he won't fly. And that's the problem with the Chinese airlines. And that has me wondering, again, as I've been scratching my head over these oil prices for the last few weeks. We know the Chinese are importing less oil, right? We know that for a fact. And we know that has widely contributed to the lack of a run-up in prices, along with the dumping of the Strategic Petroleum Reserve and other global reserves around the world. The question is this big drop in Chinese oil consumption. How much of it is the Chinese burning their reserves, and how much of it is the Chinese consumer cutting back his spending? That's a big question. Both are happening. Which is the bigger force here? I honestly don't know. I don't know how fast the Chinese are burning their reserves, or is the Chinese economy just so bad that they don't need the oil? And it's an important question, because if the Chinese consumer is slowing down as much as it looks like he might be, that will have knock-on effects for the rest of the world. It's the biggest consumer market in the world. We've got another story here. This one had me grinding my molars yesterday. Trump Media, DJT, they are selling early access to Truth Social posts. And what's going on here? Why should you care that Trump Media is selling early access to Truth Social posts? Because the only reason Trump Media even freaking exists is because President Trump posts there. That's the only reason that company even exists. There's a couple of people who are there because they're angry at Twitter and everything else. But basically, when Elon Musk bought Twitter, it completely destroyed the business prospects for Truth Social. But the president, when he posts his market-moving narratives, diatribe, whatever you want to call it, he always posts it to Truth Social. And so what he's going to do now is he's going to sell early access to those posts to banks and hedge funds so that they can front run his policy announcements that are happening via Truth Social posts. Holy shit, this is like institutionalized insider trading by the publicly traded company that is owned and named after a sitting president. Whoa, what are we doing here, guys? For a second there, I almost remembered we have an SEC. I don't know what the hell they do, but we have one, right? Isn't there an SEC? Did we get rid of it? Did Doge destroy the SEC? And I wasn't. Why am I always the last to find out about these things? This is effing disgusting. And look, I've talked about this before. President Trump is carrying on right now as if he is untouchable. After multiple impeachment attempts, having his house raided, not to mention 3, 4, 5, who's counting assassination attempts, he's pissed and he doesn't care anymore. He's doing whatever the hell he wants because he knows he is untouchable. He's going to get away with it. And that sucks because it's a horrible precedent to set. And this is not Trump derangement syndrome. I voted for the guy several times. I'm just calling it like I see it. This is effing disgusting what they're doing. And last but not least, we got another story about wheat. We were warning yesterday about wheat because of the story about Russian cruise missile and drone attacks on Ukrainian wheat infrastructure and how that was adding to existing pressures in the wheat market because of the lack of fertilizer availability, because of what's going on in the Strait of Hormuz. Well, today you can add drought in Australia to that story. Wheat prices heading higher for the foreseeable future. Guys, we got a lot to talk about this morning. Why don't we shrink my big melon of a head and let's see what's going on in the world of finance. Don't forget that like button and the subscribe button so you can come back and have your coffee with us melon heads tomorrow. Because we do this every business day, well, which means not tomorrow, by the way, Monday, because markets are closed for Saturday. Right now, the S&P 500 lower by 77 points, 1% in the red. We've got the Dow is down 461 points or 0.88% in the red. Rough morning for the Dow. but it is the NASDAQ where the fireworks are, currently down 570 points, nearly 2% lower. Again, we'll talk about the reasons why in just a minute here. It's mostly happenings in Asia and the AI bubble. We've got the dollar is stronger this morning, higher by 12 basis points, 100.85 for the DXY. Looking over at the bond market, we've got yields are a little bit lower here. The 30-year yield is down by 3 points and change at 5.064%. The 10-year yield's at 4.538, lower by 3 points and change. The 2-year yield is at 4.143. That's off by a point and change. And the 1 month is at 3.719, down by a fraction of 1. Looking over at commodities, we've got spot gold is lower again this morning, off by $9, 3,967. That's 0.2% lower. Spot silver once again heading lower here, $55.17. It was a rough day for silver yesterday. Those losses adding today got another 35 cents in the red, or 0.2% lower. Again, for the long term, I still like the shiny. We are right around support levels. You know what? I don't have this chart ready to rock, but we're going to do it right now anyway. F it, we're doing it live, says Bill O'Reilly. Let's bring up that silver chart. Let's set to daily candles. And why am I worried about this 55, 54 level? Because we are going to go ahead and put a horizontal line right there. You'll notice where we are currently at over here is exactly where we peaked twice during that big run-up last year. All right, we touched this level and rejected it once. We touched it and rejected it twice. And then we had that big run-up. Now we are back to this level. And as is said, support or resistance becomes support, and support becomes resistance. Well, the old resistance is the new support. And if this level breaks, maybe we've got some psychological support at 50. If we go below that, yikes. So let's hope this level holds. Just looking down here at the RSI, silver is pretty oversold here. We're down in the 30s. So if it catches a bounce, it would be right about this level. If it doesn't catch a bounce, look out. That's my talk on silver. But for the long term, I still like the shiny. All right, closing that guy up. Let's go back to the other metals, shall we? Copper lower by 2.1%. Platinum lower by 4.2%. Palladium lower by almost 2.9%. And crude oil is higher again this morning, 81.59. That's up by $2.60 or 3.33% here this morning. More issues going on in the Middle East. We had the United States bomb some bridges in Iran yesterday. The Iranians retaliated against freaking everybody. They also hit a desalination and power plant in Kuwait. We don't know about the damage if the water production was knocked offline, but civilian infrastructure is now being targeted, which marks an escalation. So what is the next step in the escalation ladder? You've got, I don't know, hitting more oil infrastructure. You've got Karg Island on the U.S. side that we could hit, bridge and power plant day, if you will. The Iranians could activate their proxies. Hezbollah, who is still fighting with the Israelis, but notably the Iranians have not been directly attacking the Israelis since this recent flare-up of hostilities. So that could resume. You could also get the Houthis down there in the Bab el-Mandeb Strait. They could start getting a little froggy. There have been rumors that they are preparing to shut down that waterway as well. So yeah, more issues in the Middle East. Oil moving higher, but again, still kind of a muted reaction considering how bad things have gotten. 81.5 a barrel isn't that bad. Looking over at Bitcoin, it is lower this morning as tech sells off. $62,902 is priced on Coinbase. That's off by about $866. All right, here's the story that's driving it. China's powerful new AI surprises investors, fueling tech rout. This one this morning in Bloomberg. A surprise breakthrough from Chinese AI startup Moonshot rippled through global markets on Friday, sending AI and semiconductor stocks sharply lower as investors drew parallels with last year's DeepSeek moment and questioned whether the industry's enormous spending spree is becoming harder to justify. It's impossible to justify, if you ask me, but I digress. The catalyst was Moonshot's new Kimi K3 model, which the company said rivals the strongest offerings from OpenAI and Anthropic. The launch was quickly dubbed a new Kimi moment by investors, or maybe a new DeepSeek moment, echoing the market shock unleashed by Chinese startup DeepSeek's breakthrough last year. People are worried that if U.S. companies start using Chinese models more and Anthropic less, then Anthropic will invest less. That means those U.S. firms will lower the capex, and in the end, chip demand will be affected. say Vaser Ling, managing director at Union Bancaire Privy. I don't know who that is. Such worries have abounded since April when DeepSeek launched its V4 model, while the release of K3 just deepened such concerns. Guys, there's a new model announced every day. Nobody cares outside of software developers who won't shut up on Twitter. Nobody cares about the new model because they're all the same. They're only marginally better. What are we doing here? We spent trillions of dollars on this crap, and we have accomplished virtually nothing other than the slopification of the internet and a bunch of buggy code. Anyways, that's spreading the Asian volatility. We got Asian markets tumble as AI stock sell-off deepens. Nikkei sinks nearly 6%, and HSI plunges 2%. Now, the Nikkei recovered some of those losses. It ended up closing down about 4%. Asian equities tumbled in red on Friday as concerns over artificial intelligence led stocks deepened, with Japan and Taiwan recording the sharpest declines. Additionally, growing tensions in the Middle East also kept investors cautious, lifting oil prices while U.S. futures traded lower. Japan's Nikkei 225 led the regional losses, plunging 5.8% after computer chip makers and other AI-linked companies witnessed broad-based selling. Taiwan's benchmark also dropped more than 5%, while trading remained shut in South Korea. That's for a holiday. Elsewhere in the region, Hong Kong's Hang Seng Index slipped 2%. China's Shanghai Composite fell 1.6%. And Australia's ASX lost 0.7%. The weakness in AI-related shares reflects growing investor concerns that the sector's sharp rally may have outpaced fundamentals, you think? Markets are also weighing whether demand for advanced computer memory and processors will remain strong if artificial intelligence fails to generate the profits and productivity gains many investors have been expecting. Are we still talking? How are we still talking about this? It's been 4 freaking years and they have not accomplished what they said they would. Their only accomplishment is wasting money, and they're bragging about it. It is so stupid, but they keep doing it. This bubble can't burst fast enough. And in some regards, it already has burst or is bursting. It's starting in memory. Take this one, for example. Chipmaker Kioxia's market value halves from peak of AI sell-off. By the way, does anybody else have trouble with the word halves? I have trouble with halves. Anyways, it was cut in half. Japanese memory chipmaker Kioxia Holdings market cap in halved. There it is. There's that word again. Japanese chipmaker Kioxia's market cap halved in just a month since becoming the nation's most valuable company. On growing concerns, the AI-driven rally in the sector has gone too far. Kioxia shares tumbled 16% on Friday, down 52% from last month's peak, and losing almost 31 trillion yen. That's about $190 billion in value. In mid-June, Kioxia overtook auto giant Tokyo Motor in market cap after stock rallied more than 600% from the start of the year, driven by exuberance about demand for memory and data storage amid an AI boom. Its ranking has since dropped to the 4th largest Japanese company. The chip sector is vulnerable to the silicon cycle. Oh, that other heavily commoditized cyclical industry, yes. And we've seen this pattern many times before, said Yugo Tsuboi, chief strategist at Daiwa Securities. Chinese memory chip makers are gaining attention, and people are starting to think that the rise in memory prices globally may start to settle down. It's become harder to keep pricing in further acceleration in earnings growth, and fast money investors may have rushed to take profits for now. And take profits they did. Look at the shares of Kioxia. These are daily candles going back to late last year. Again, a 600% run up in price, and then they immediately give back 300% of that in the ensuing few weeks. Guys, this is a bubble burst in Prague, is what you're looking at here. Down 16% yesterday. This is priced in yen, 52,110 yen. Big drops, big increases in volatility. And we've seen this chart. This looks just like the chart of the Kospi index, which was closed yesterday. Bubble is bursting, guys. We're watching it happen. And SpaceX is along for the ride as well. SpaceX post-listing collapse threatens IPO markets, AI euphoria. SpaceX is now below its IPO price. You better believe Anthropic and OpenAI are looking at that. SpaceX's fall from its post-listing peak to below its IPO price in just a month poured cold water on the market for newly public companies, dragging a key gauge of this year's debuts down with it. The pullback across stocks linked to themes such as AI, infrastructure, and aerospace and defense, two of the hottest sectors for newly public companies, depressed the weighted average return for this year's U.S. IPO offerings to 6%, lagging the S&P's 11% return, according to data compiled by Bloomberg. Broader market volatility, including share price declines for recent listings, is set to dampen enthusiasm for what a Blackstone executive dubbed the year of the IPO. The majority of U.S. debuts over the past 2 months are trading below their offer price, data compiled by Bloomberg shows. SpaceX slumped 3% Thursday, on pace for an 8th drop in 9 sessions, as it wiped out $903 billion from a closing high last month. SpaceX is down almost $1 trillion from its all-time high. And the company's what, a month old? Shares of SK Hynix, which raised $26.5 billion in a record-setting debut of its own last week, dropped 12%, bringing it just a few dollars above the $149 level where it sold American depository receipts to investors. And SpaceX down again this morning, fell 3% yesterday. It's off another 4.3% ahead of the opening bell, $125.50 for SpaceX, off by another $5. And look, this thing went, some would say this thing went apeshit after the IPO. It went as high as what, $225, currently at $125. This one too has nearly halved or halved. Yeah, cut in half almost. All right, now let's talk about Nebius. This one, and I just love this. The NeoCloud investors, they initially bought this story before they realized what this actually means. You just got to love these guys. Nebius embarks on asset-light data center model. Now, let me just go right out and say asset-light and data center do not belong in the same freaking sentence, not ever. And yet here we are. The NeoCloud is turning to infrastructure partners to expand compute without having to foot the bill. Again, it's better to have a friend with a boat than to own one yourself, because when you own it yourself, you have to pay for all the maintenance, the upkeep, and it's expensive, and break out another 1,000, the acronym for boat. Yeah, data centers are the same thing, a black hole that you endlessly pour money into, just like a boat. To meet rising compute demand, Dutch NeoCloud Nebius is turning to infrastructure partners to run its AI cloud platform in their own data centers. The new business model allows the NeoCloud company to expand compute capacity without having to foot the bill for construction of new facilities itself. Nebius framed the approach as a win-win, with partners retaining technology ownership while getting a quick route to market, while the NeoCloud company can offer more capacity to customers. Nebius is cutting their capital spending. That's what this means. Now, Nebius is a logical choice for the first one to cut. Nebius has always been far more cautious than their cousins over at CoreWeave. Oh my God, don't even get me started on those guys. But this is the first indicator of anyone slowing their spending on GPUs. Now, Nebius is saying, we're going to let our partners do that spending, as if to suggest it doesn't mean spending is going to slow. That's them trying to put a positive spin on this. Now, initially, the Nebius bros bought this story. It was stupid. And then yesterday they came to their senses and realized, oh shit, I've just realized what this actually means. It means the build out may be coming to an end. And Nebius stock fell 13.9% on that news yesterday, and it's down another 3.6% ahead of the open this morning, $165.50 for Nebius. All right, now on to Netflix. Lacks excitement. Netflix tumbles 9% as weak earnings forecast deepens doubts over growth. Netflix shares tumbled at 9% before the bell Friday, following another weaker than expected earnings forecast from the streaming major, deepening doubts about its ability to sustain growth momentum. Speaking of commoditized spaces, I mean, everyone and their brother has a streaming platform now, and there's a price war, same freaking thing. While the company has gone beyond its traditional subscription-driven model, relying on advertising, live content, and price hikes to boost revenue per user, it has been locked in a battle for user attention with traditional media such as Disney and social media such as YouTube. The stock is down more than 44% since hitting an all-time high in June of 2025. The story lacks excitement, said Jeff. Oh man, I'm not even going to try to pronounce that name. Said Jeff. Thank you, Jeff, analyst at Pivotal Research Group. Subscriber growth remains central to Netflix's business, he said, adding that younger audiences are increasingly gravitating towards free social media platforms over long-form content. We believe this will result in slower subscriber growth and attempts by the company to offset this via more aggressive price increases and investment in content. The company forecasts quarterly earnings per share and revenue below analyst estimates for a second quarter in a row on Thursday, with at least 11 analysts lowering their price targets. And Netflix is suffering because of it. Shares down almost 11.5% ahead of the open, $65.86 for Netflix. Meanwhile, China's top airlines warn of heavy losses ahead of uncertain summer. And it is that uncertain summer that has really started to make me wonder just how much of this oil story is the dumping of reserves and how much is demand destruction in China. China's biggest airlines enter the peak summer travel season facing a more challenging outlook after warning of heavy first-half losses, with weakening demand raising doubts that they can absorb higher fuel costs during the industry's busiest months. Air China, China Eastern Airlines, and China Southern Airlines all warned on Tuesday they expected combined first-half net losses of up to 9 billion yuan, or $1.33 billion US. That is a sharp reversal from their combined first-quarter profit, which had been boosted by strong Lunar New Year demand. The losses underscore the dilemma facing Chinese airlines. Raising fares to recover higher fuel costs risks further weakening demand, while keeping ticket prices low leaves carriers absorbing the additional expense. Parash Jain, HSBC Global's head of transport and logistics research, said a negative wealth effect was reshaping Chinese consumer habits as economic growth slowed and every airfare increase risked lowering demand. And I agree with Mr. Parash here. That's a very good sentence. Negative wealth effect. All right. The wealth effect is when home prices go down, you feel poor and you don't spend as much. We observed that here in the United States after the GFC, when there was a significant drop in consumer spending that went along with the decline in home prices, an even bigger drop in consumer spending than you would expect given what unemployment did in the GFC. People feel less wealthy, they spend less. And in China, there is nothing more important to the average household wealth than housing. All right. The Chinese have put everything, every single egg in the one basket of home values. And so the Chinese consumer is spending less here. And the Chinese airlines are warning jet fuel prices have gone up because of the Strait of Hormuz. We can't raise our prices. The Chinese consumer won't pay it and they'll fly less. So they're saying we've got big losses on the horizon. So how much of this $80 oil is because of reserves being burned, and how much of this $80 oil is because demand is just being destroyed? It's really hard to tell. We don't have a lot of clarity. We can't really see inside the Chinese economy that well to tell what's really going on. All right, and then we've got this one. Trump offering instant paid access to Truth Social posts. It sounds innocent enough until you realize this is the president directly selling insider trading information through his publicly traded company while sitting in the freaking Oval Office. I kid you not. President Donald Trump's social media company plans to offer Wall Street's professional traders a way to access his Truth Social feed milliseconds faster than manually checking the platform, which he often uses to make official policy pronouncements and divulge other market-moving news. And don't for a second think that millisecond thing is material here, because that is all the time these trading firms need for their algorithms to get that information before anybody else and make billion-dollar freaking trades off of what the president says on Truth Social, which, by the way, he very often posts about his own freaking company that he invests in. This is legalized sale of insider information for the purpose of insider trading. Trump Media Technology Group says it expects the feed will be available to institutional customers starting on August 1st, and that it has already signed up some customers. The feed and API, or application programming interface, means followers of Trump's social media account and other high-ranking accounts won't have to constantly watch the platform, because the system will deliver his posts automatically to those who sign up for it. Financial services companies and other firms that prioritize speed often pay for APIs from social media platforms to get faster access to data. Yeah, they just don't offer to pay directly to a sitting president for it. Let's not be like, everybody does it. No, they do not. Trump Media Group was up a fraction of a percent on this news yesterday. It's down 3.5% ahead of the opening here at $9.29. By the way, guys, I have no position in Trump Media. I was formerly short this company. I shorted this company when they had a big run-up following their announcement of the acquisition of TAE Holdings. That was a layup of a short. We all knew Trump Media was not going to solve the fusion problem. Made a bunch of money on that trade. Now I'm out of it. I may be putting the short back on this one, but right now, no position. All right, last one of the day. Major Australia grain states wheat crop forecast to drop by 30%. Keep an eye on food prices. All right, I think this is a theme we're probably going to be seeing for quite a while. The wheat crop in Australia's largest grain exporting state is expected to shrink by almost 30% year on year due to hot and dry conditions forecast over the next few months, according to an industry body. In its first survey of production for the 2026 crop, the Grain Industry Association of Western Australia forecast that the state will harvest 9.5 million tons of wheat. That's down from 13.3 million tons in 2025. Yikes, that is a big drop. Overall, grain production in Western Australia was estimated at 22.7 million tons, down from 27.4 million last year, according to the study that was published on Friday. Australia is one of the world's largest wheat exporters, sending cargoes to developing nations across Southeast Asia, as well as the Middle East and China. The growing consensus around a smaller 2026 wheat crop in Australia comes after the latest escalation in the conflict between Russia and Ukraine sent futures soaring to a 2-year high this week. The heat wave in the Northern Hemisphere has also impacted farmers, and we've got higher fertilizer prices because of the Strait of Hormuz. Guys, are we back to 2022 and the higher food prices on the horizon again? Starting to look like it. So keep one eye on those global food prices. And remember, when it gets too expensive to eat, people get pissed off. You end up with social unrest when food prices rise. And on that happy note, let's wrap this one up. Thank you, everybody, for having your coffee with the Melon Heads this morning. Don't forget that like button and that subscribe button. And don't forget, it's Friday, which means 2 p.m. Eastern Time today, our weekly get-together for a Q&A on Zoom for my Patreon members, YouTube members, and Buy Me a Coffee supporters. Thank you so much to all you guys who support the channel. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. Everybody, till next time, live small and dream big.